how can a business that's kind of operating in the red, maybe they've been operating in the black for a few years, they're profitable, and then they have a year that goes a little bit south, and then they want to get a loan to kind of change some things like, oh, you know what, we actually need a sales team. We can't just rely on Jimmy over there to do all these calls. So I want to get into those type of situations, like when things are going a little bit rough and how to manage that kind of financially with the bank. But first, business credit scores. I know so little about this. It is hilarious. I know that it's a real thing. I know that there's a different like scale in which, but what is it? How is it determined? What's a good score? What's a bad score?
The SBA came out with I can never remember these letters, like a SBRC score or something along those lines, and I believe that's up to like 250,000 or 350 or something along those lines, and it factors all that stuff in: business score, personal credit, industry, financial information, and it kicks out a number. If the actual applicant's number is above that, hey, no problem. If it's below that, the bank needs to justify why we're moving forward with it. So I'll give you an example. One of the recent deals that I did, and I don't remember what that score is, and its system's kind of relatively new. So it was below the number. So I had to justify to the underwriter, okay, well, why are we going to move forward with the score being what it was? And justification was like simply, hey, look, there's enough equity in their home. We're fully collateralized. So if there's any issue that comes up, we should be in a good,
right. Yeah, you have that safety net.
So as it relates to, the business score, that's kind of where, and now for deals more than that, I'll be honest with you, we really don't look at it all too much.
Really?
Yeah, we're really focused on the historical financials.
There we go.
That's really the determining, and personal credit. The best way I can explain this is like it's like legs of a table. So we've got personal credit, business financials, collateral, use of proceeds. So there's a whole bunch of C's to credit, right? And depending on what's lacking, all right, well, are the other legs strong enough to support what's, the weak leg here? Right. So that's kind of how we approach lending.
That's it's still such a foreign idea to me, this whole business credit score situation.
It's a different algorithm than a personal credit.
Right.
But
there's
different factors.
The biggest takeaway for me from this conversation about this particular topic is that it's kind of like yeah, it's there, but this isn't the make or break thing.
Yes.
Like
like
a personal credit score.
Yes. So I think, and Jeff, correct me if I'm wrong, I think that why there's such a huge difference, right, is because with the personal credit, everything is being reported, right? You got 3 credit reporting agencies, and I think it's less so on the business,
right?
It's
not weighed as heavily as the personal credit.
Yes,
because there's a lot more factors that can determine the business credit score.
Yeah.
Maybe vendors that you're buying from are complaining, things like that.
Oh, wow.
There's a lot more involved.
Holy smokes.
But the personal credit is you.
Yeah.
It's basically it's how you handle your finances.
And it's kind of like it's part of, if you view this, I kind of view I take things that are a little bit abstract to me, and then I tie it to things that make sense to me, right? So I look at applying for a business loan like a job interview. I have to prove to you that I'm capable of performing the tasks and functions in this job, and I'm actually a value add.
You're selling yourself and the business.
And the credit score is just the numerical grading system of that is tallying not like who you are as a person, but your decision-making process when it comes to handling money.
Correct.
And that's why it's so important, even for established businesses when they're going out and seeking additional money. Because if you're not handling money great in your personal life, where's the indication that you're going to be handling it?
Right. And that's the first question I ask clients is when we're talking about lending. I said, what's your personal credit score? I said, and then be honest with me because it's going to get checked.
Yeah, yes, absolutely.
I promise. No, you're fine. It's one of those things that, I tried my strategy with that after many conversations with you about this very topic is, like I have no say in whether or not the loan comes or not.
Right.
So lying to me isn't going to benefit you in any way, and lying to the bank isn't either because everyone's just going to check and see.
The common answer is, "Oh, it's good."
Yeah, if I may, I do have an example towards
Please.
lying or not just being truthful. So
Right.
it was a loan that I did many years ago. Gentleman who was a chef professionally, worked at a whole bunch of catering halls, so on and so forth. So he kind of retired from that, and then he found a new passion in making cakes, right? So we started to do that, and fell in love with it, and went to school, got his cake making degree, and all that and all that other stuff. So he took his savings, right, and started and wanted to open up his cake business, right? But these aren't the type of cakes that you and I, will go in there, and these are like, $10, $15, $20,000 cakes in, Huntington area where, you've got Crest Hollow, Fox Hollow, you got all those catering halls and so on and so forth. So he took his life savings, put it into the business, right? Revamping a beautiful, to this day, probably one of the nicest retail locations I've ever been in. But it was next to a pawnbroker. It was next to other businesses, small little strip mall that you would think. And I asked him, I said, you got a really nice location, but, if you build it, will they come? And he said yes. So he said that he really doesn't need the location because he's not picking up people off the street. Mm-hmm. So he's going to be recommended by these caterers, and then they're going to come. Okay, makes sense. I can see the viability in that, right? So throughout the process, I asked him for letters of intent, and he got these letters, recommendation, and all that other stuff. So,
and these are letters of intent from potential like clients, customers of his that are like
potential catering.
Oh, that would bring him.
That
on.
would yes,
Right.
that would.
Understood.
He was supposed to be part of he would be part of a package.
Mm-hmm.
Got it.
Cool, not a problem. So we did the loan, right? Lo and behold, I don't think he sold one cake. Oh no! So what happened was all that information he made up.
Oh no!
And I'm just like, why would you? Why would you do that?
Unbridled confidence in oneself
yes.
can be a good thing.
Yeah,
to a certain extent, or you cannot sell a cake.
Yeah, yeah. Well, all that equipment was liquidated, and the appraiser was just like, "This is." Some of the stuff was still wrapped of the equipment that he bought.
His life savings.
His life savings. So ergo, he had to sell his. I don't know. I think he was in an apartment, but he had to move in with his daughter, and But yeah, it was a tough. Every now and then you come across a deal that just that just gut wrenches you.
That's not fun.
Yeah, but just be honest.
With yourself.
Yes.
Like start with yourself and like, can I afford this? Is this a reasonable plan? Yeah. Like, am I confident in being able? Do I have the actual connections to see this deal? Especially for that in particularly, like how many people do I know right now that would come to me for this service? Yeah. Right. Yeah. And if the answer is not a lot, then that idea of not relying on foot traffic and not worrying about location as much is, that's rough. And that's a good point. It's a really good business point when it comes to like business and location selection and stuff. It's a conversation for another time. Yeah. It's definitely huge. I mean, we talked about it a bit. We had a real estate, commercial real estate, podcast we did a little while ago, and that we talked a lot about location.
Gotcha.
It's so important. And then you think about the type of business you have and where it's set amongst the people around you.
It's true. When I started my business, and I was looking for strip shopping centers, and basically I wanted to have in that strip shopping center other types of businesses where it's a 2-day process, where you drop off, pick up, something
dry
like
cleaning,
that.
something along those
So
lines.
I wanted to look for dry cleaners, and I also wanted to look for pizza places, okay, because we can cross-advertise with each other. And basically, the cleaners was right next to me, and it was a godsend because a lot of times they would come before our store opened up to return the tape, and we weren't open to accept it at that point, but they dropped it off at the cleaners. So the cleaners, you drop off and you pick up the next day. At video, you pick up and drop it off the next day, just the opposite.
And you just make you simplify the trip.
Exactly.
Yeah.
And then with the pizza place, what I did was cross-advertising. If they bought X amount of dollars worth of pizza, you give them a $5 off coupon for the video store in the same shopping center. And we did that constantly. I would give out coupons for the pizza place also if they had X amount of rentals. So, you look for certain things in that particular location that can benefit you and these other businesses. Yep. And, that's important. But that's all thinking ahead, too.
Yes.
And that's part of doing the homework of starting a business.
Absolutely.
Really.
No, that's great insight. It changes the way that people view kind of relationship management and networking. So a lot of people want to spend the time in their business and they do all of this market research and, they figure out their target audience and what's their value proposition and all of these super important things that really matter a lot. But they don't think about the kind of outside of the box stuff. Establishing relationships with the people that you're physically working next to and the type of hell that can wreak on your business if you get into other businesses that don't operate that way. The owners you have a bad relationship with them, and how that can impact things. And if they don't run a great business and you're next to it, then it's rough. It's rough. So when we go and we're thinking about an established business, right, and they're seeking and they're in that, let's take on that scenario I kind of alluded to earlier. So we have a business that has, let's say they've been open for 5 years. 4 of the years they have been, let's say they built up first 2 years, increased revenue. 3rd year, 4th year, they kind of stabilize. And then the 5th year, they fall off and they're actually, their tax returns reflect that they're negative.
Okay.
Right? And now they want to reinvest into their business because they see that some of the problems that are occurring. What do you want to see from this business?
So in that scenario, along with startups, we're going to need, because there's negative cash flow in the year, we're going to need projections.
Okay.
Right. So we're going to need projections. We're going to need assumptions. So it's just okay, well, you've been doing good. You hit a bump in the road. Well, what's that bump? Why did you hit the bump in the road? Right.
So you have to understand the problem
first.
first.
Yes, absolutely. And also want to know how you're going to go forward. What was it? Somebody else I was financing, and there was a contract, they had a business where they dealt with contracts, and they lost a major contract, that year. Yep. But you know what? They realized it, and going forward, they're going to look to bring on more salespeople and start working on smaller contracts. So if they lose one, it's not going to be that much of a detriment to business operations. So, it's things like that you got to ask, and you got to get your hands behind.
Yeah, you want to know their clients, what percentage of your business is with this client. Now, you could have a client that's been supporting your business for 10 years, and all of a sudden you lose them, and they supplied 50% of your business. You're going to take a major nosedive at that point. So, you want to be diversified with your clients as much as possible.
Such a good point. That's one of the things that I talk to people when they're in that very, very, very early stage, when they're considering entrepreneurship or business ownership, is I have that exact conversation.
Right.
And it's, okay, no matter what, you're going to be working for somebody else. When you own your own business, it's what you're doing is you're shifting. If you shift from a 9-to-5 to working at a 9-to-5 to creating a 9-to-5 or whatever for other people, you're just trading the number of people that you work for. And so, but it's interesting the propensity, and maybe it's because we've had this built into us from working for other people, is for when you get into business, and if you're dealing with that kind of thing, when you're working with clients versus customers, kind of a different thing. And so you have there's a propensity to go to I have this one client, and it makes it simple. because then I just deal with this person.
Yeah.
But when they're bringing in 90% of your company's revenue, it's the question comes back up like, are you an entrepreneur?
Yeah.
Like, are you a business owner, or do you just work for this person?
That's a red flag.
Yeah.
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 Big time.
When it comes to
Yeah.
like their finances, or what do you mean?
Even applying for a loan.
Yeah.
Right.
Yeah. When it comes to
Really?
finances, sure.
You're
Yeah.
too dependent on one client for
Yep.
this business to be successful.
Wow. So that's
Really?
important, the
Big time.
diversification and spreading that wealth out. I know when I was working for that sales company that was based out of Britain, out of London specifically, they always talked about the long tail of sales, like, and of business relationships and adding more clients. They're like, do we want the big ones? Yeah, buddy, we want the big ones. But we also want our tail to be super long, chocked full of all these mid-size, little size, because we don't want exactly that thing. Like, all it takes is turn around, like, yeah, we're in a contract with them for 3 years. 3 years rolls over, and it's like, if they don't renew, what happens to us? Okay, we just lost 2 salesmen,
Right.
because now we don't have the revenue to keep this department up.
And also with small businesses, and I'm not exaggerating when I say small businesses.
Mhm.
Okay, you always have to look. I asked the client, because when I had my business, I was always looking for other sources of revenue for the business. That's how I'm going to grow this business. I can't count on growing the business by getting more members, really, because there's just X amount of videos I can keep in the store.
Right. Yeah.
So I was always looking for alternate sources of revenue, and right away I applied for a Ticketmaster machine to be a Ticketmaster agent, and I got it, and that helped tremendously. I didn't make a lot of money from Ticketmaster itself, but I got new customers because of it. All right.
While I'm there.
Exactly, and also somebody came in and said, "Well, how about I put in pinball machines in your store?" And at first I said, "Nah, I don't think I'll need that." Sure enough, he puts in 3 pinball machines, and those machines are racking up.
Oh, really?
I mean, the people loved it. I never played pinball much, but these people were great. It was like, my God, the pinball wizards.
Yeah.
They came out of the woodwork. And I kept telling them, all right, every month I want different machines, because my customers are getting tired of the same ones.
Same ones, gotcha.
Exactly,
Gotcha.
right?
Look at this.
And then I said,
Jeff's a
all
killer.
right, so you're coming in to rent the video. I want a rack with potato chips and popcorn and stuff like that,
snacks.
so you can buy that. I actually, I bought a popcorn machine, one of the big kettle machines, and I didn't get it to make money. They said the smell's going to be intoxicating when they walk in. And what a difference that made.
Yeah.
Really. People loved it. As soon as they walked in, and I was giving it away for free.
Gotcha.
You know, you rent 2 movies, you get a bag of popcorn.
Yeah.
And
Wow.
it just keeps them coming back, because you have to have an edge over your competition, because they're so they're nearby and they're selling the same product you are. So,
Yeah.
you know,
No, that's-
you have to think out of the box once you get the business going too.
It's so funny that you brought that. That's a recommendation I make to people that are in the farmers market stage, if they're doing like food products or like making their shirts or whatever. Is I'm like, is there something that you can do that produces what's the word? A desirable smell, like an aroma that people want to smell. Like, so some people want to start their own coffee companies. Some people want to make their own bread and stuff like that and sell it. And I'm like, you don't show up to the farmer's market with it pre-made. Like, obviously have your product ready to sell, but show up with your bread maker. Make that bread. Show up with 5 bread makers and just be pumping it out. Make sure that it's in the stage of whatever when it's the most aromatic, right? And to get people's, because we're sensory, you know.
Well, it's like when you sell a house, they say bake a cake or bake a pie.
Right?
Oh my God.
It's that just for the smell in the place.
That's right.
Really?
I forgot about that. That's so funny. I want to revert back to a breakdown, and this goes for both of you, absolutely, but we'll start with Kendro. When it comes to understanding the difference of the purposes, we kind of already covered the LOC, the lines of credit. But what is the difference, and what is the reason that both of these exist? What between the SBA loan and a conventional loan?
Yeah, right. So at the heart of it, right, the U.S. economy is based on small businesses. And it's risky. You know, they are risky. So on a conventional side, banks are, because there's more risk that's inherited, banks aren't going to generally lend to them. Ergo, that's why we have SBA financing, and the government gives anywhere from 50 to 90% guarantee.
And
so-
so just to break down in super layman's terms.
Yeah.
So how and what impact does that have, and how does that impact the lending situation?
Sure. So if I use request A, right? There's really only one request.
Mhm.
Sorry. We're looking at, right, startup, or doesn't even necessarily need to be startup.
Mm-hmm.
Maybe lack of collateral.
Got it.
Right?
Okay.
Maybe historical cash flow isn't there.
Okay.
Okay. Maybe experience isn't there. Right. So on the conventional side, no bank's touching them. On the SBA side, because of the government guarantee, the bank would be more not averse, but would be more apt to lend them the financing that they need.
Is that the typical kind of process? Is everyone's going to start observe through the lens of conventional?
No.
And then if you don't make that, then you go SBA?
Well, I mean, typically, yes, depending on if it's startup, right, then you're going SBA.
Got it.
Right.
Yeah.
I don't know any bank that's really financing startups on a conventional side.
Understood. Okay.
So let's say your example before where you're in operations for 5 years, right? 4 years, you're, kicking butt. The 5th year, you took a hit.
Right.
On the conventional side, yeah, they're going to look at it, but the likelihood is they're probably going to filter you down to SBA.
Wow. Okay.
Because of that, right? They want to see historical cash flow, and their debt service requirements are generally about 1.25 historically, whereas on SBA
So
side,
what does that break that down? What does that mean?
So for every dollar of debt that you have, you've got to be making $1.25 to cover.
That's what the
Right.
that's what the bank
that's
is
what
expecting to
25
see
Yes.
in your revenue that you're bringing in
Historically.
Okay. Historically,
Yes,
like from the
and
past.
currently, yes,
Got it.
exactly.
Okay.
Right.
But
Okay.
what's
So that
important
you
is-
want that cash flow statement that brings you, or the budget that's like year to date,
They'll want
Yes.
3 years
Yes.
to compare
3 years
Yes,
backwards,
exactly.
and then
Yep.
what's going on
and
right now.
current.
Okay.
Exactly.
And then in that, so yeah, for every dollar, then you need to be making that you're requesting.
Yes.
You need to be making 125.
1.25
Yes.
of it.
Yep.
Yeah.
Yep.
Okay.
Right.
Yep.
Okay.
Now, whereas SBA comes in, debt service we're looking at a 1.15, but we can do things on a projected basis.
Got it.
So even though, again, your example, 4 years, you're at a 1.15, but the 5th year, you're at a, 0.5 or something along those lines. With projections and assumptions and an understanding as to how you got in that situation, how you're going to get out of that situation, we'll be able to move forward. Whereas conventionally,
It's cut and dry.
So
yes.
okay,
Yeah.
so I want to get real kind of tactical or tangible here. So in this situation, let's say it's me, it's my business,
Yes.
right? And 4 years rocking, 5th year red, right? And what are you actually expect? Like, do you want my business plan? And
Well,
do you want, like, how are you expecting this as far as like kind of a package that I'm delivering?
Sure. So, we would look for 3 years personal tax returns, 3 years corporate tax returns, personal financial statement for the principals, anybody, 20% or more.
And so what is
And-
included in a personal financial statement?
So, in essence, it's going to be the assets, your personal assets,
Okay.
your personal liabilities, and that's really it.
It's a personal balance sheet.
Yes,
Got it.
personal balance.
Right.
Okay.
And it
Cars,
gauges,
houses,
Yes.
boats,
right, it gauges
whatever.
your net worth.
Okay.
Yeah.
Oh, and so that's the purpose of that document is
Yep.
to reflect your net worth.
Yes.
Yeah,
Ish.
yeah,
Yeah.
yeah. But
Okay.
also when we look at it, it tells us, all right, again, right, from an SBA's perspective, if there's not enough assets in the business, we're going to take your house. So that tells us, all right, what
do you have that we can
do
take?
you have that? Yes. Yes,
Not what do you have that we can take?
Yeah.
But what do
Yeah.
you have that's going to cover this if things go
Yes,
south?
exactly.
If you're the cake maker.
Yes, exactly.
And the last thing
Exactly.
the bank wants is to take your house.
Yes.
Really.
It seems like it's more complicated and more difficult
It
for you guys
is,
to manage
yes.
than if the loan just works out.
Correct.
So it's there as a safety net, but it's not even preferred for you guys.
Yeah, it's not. It's really
They
not.
won't get the value of the house.
Yeah, but not only that, but how often do you want to, read on Newsday, bank kicks out a, family of 4.
100%.
It's just not.
That's
Yeah.
why it's so hard to get loans for churches and synagogues.
Yes, yep.
The
that's
last thing you want to read in the
reputational risk.
paper is,
Yeah.
oh,
Wow.
this bank put this synagogue or church out of business.
Yes, yeah.
Sorry, fellas.
Yeah.
Guess you didn't pray enough.
Yeah. Exactly. Exactly.
Oh my God. So okay.
What I wanted to ask you,
Yeah,
with the 7A loans,
Mhm.
let's say it's a startup, the projections are really good, the business plan's very good, but they want the funds for various things. Now, I know with the 7A, it covers a lot of things like
Yes.
equipment purchases,
Mhm.
working capital.
Mhm.
Now, do they become separate loans? Because like,
No. So what it is, it becomes a multiple disbursement loan.
okay,
So let's say, for example, I'll real life example, right?
sorry
Startup
if
I'm
I'm off
looking at.
the track here.
No, this is perfect.
Startup funded $200,000. Okay. Let's just say it's a franchise. All right. They need to get leasehold improvements done. So out of the 200,000, 50 is for leasehold improvements, 50 is for working capital, 50 is for equipment, and 50 is for inventory. Right. So day one, we close, right? They're approved. They close on a $200,000 loan. But let's say, for example, they need to start hiring people, training. So out of that $50,000 for working capital, maybe we'll fund them $25,000 day one to kind of help keep things, to kind of like that match per se, right? We'll pay the vendors for the leasehold improvements directly, right? So, or we can cut them out a check, but we, like to just kind of pay for them, directly. So they'll get the work started. So there'll be an initial deposit. We'll do that. Then they'll get the work going as the project continues. We'll fund them, directly. So now they've hired people. They're going through training. The store is retrofitted to the franchise specifications. So now they got to get the equipment in. So we'll fund the equipment vendors directly. Now, if there's lead time, if there's 3 months lead time, something along those lines, we can fund that at closing, so it really kind of depends. So now, okay, right, we got the operations or the people are hired, they're going through training, leasehold's done, the equipment's done, and then there's a remaining balance of about $25,000 for the rest of the leaseholds, for the rest of the working capital. So when they're ready to go, we'll fund them the balance. We get the
So now
CFO,
they'll have
they're
a
ready to go.
specific working capital line of credit.
Well, no, not a line of credit. It's just a term loan,
Okay.
right? So
Baked
it's
into
just
the 200,000.
yeah, but it's just like you divvy up like a pizza pie, right? So you're gonna get 2 slices at closing. You get this done. When it's time for this, you'll get another 2 slices, another 2 slices, and another 2 slices. Now, one thing we were talking about lines of credits before. The SBA Express line of credit, it works differently than a conventional line of credit.
Okay.
Now, the difference is the term is up to 10 years.
Okay.
All right. The first 5 years, it's a revolver.
Okay.
The other 5 years, whatever the balance is, gets turned into
out.
a 5-year term loan.
Right.
So on that one, there's no cleanup requirement.
Okay.
So on that type of loan, right, you can take it all day one. You pay back into it. It becomes available for you to draw upon it. So it's totally different. But here's the caveat, right? We don't give that option to startup businesses, really. We have, but there's got to be some strong parameters. And the reason why, it's the guarantee. There's only a 50% guarantee on that. So
By the SBA.
Through the SBA.
So the bank
So
has
the bank's exposure is more.
Exactly.
So if you're an established business, and we've done that. I've done a type of business, a furniture business, right? And did a 504. He bought the building, saved a ton of money on rent. Now he's getting into government contracts. So IRS buildings, things of that nature. He's outfitting, right? So he expanded to more than just furniture. He's doing painting, he's doing carpet, all that other stuff.
Wow.
So I had provided him a $500,000 express line of credit to support that, the growth of that.
500,000?
500,000, yeah.
Wow.
Express goes that high?
Yeah. I think it's between COVID, I think at most, or initially was 250, either 250 or 350. Then COVID hit, and I think it went up to $1 million.
Wow.
Then they brought it back to $500,000, and I think that's where it is.
So the express line of credit is that 10-year, first 5 years revolving, next 5 years
Yeah,
terms
max term. I mean, they can do 3 and 3, something along those lines, but the max it goes out to is a full 10 years.
So I guess it's a great segue into like what are the different. So that's one tool or asset or resource through the SBA. What are the different like financing options?
So really, you've got two. You've got the SBA 504, which is primarily for the purchase of real estate.
Okay.
Right.
commercial building.
Commercial
Okay.
building.
Okay.
Yeah. Now you can what I guess recently you can use that 504 to refinance a 7A if it was purchased, if the use of proceeds were used to purchase or make improvement to real estate or equipment.
Okay. So if you got a 7A, which is more generalized.
So the 7A typically, right, the major difference is because everything with the 504, like everything you can do with 504, you can do with 7A.
Okay.
But generally the 7A carries a variable rate,
Oh, interesting. Okay.
whereas the 504 is a fixed rate.
Understood.
And you have two mortgages.
Yes.
50% is the mortgage from the bank,
Yep.
40% is the mortgage from the SBA, and 10% is your down payment.
And so
Yeah.
your expectations
Or
of somebody's
equity that's already in the
Right.
property.
Right.
okay.
Right.
Yeah.
Oh, so that could work instead of
That
the 10%.
would be your
So you get
Okay.
two actual mortgage statements because you're making two separate payments.
Yeah.
And they go to two different locations because it's not the same person.
Right.
It's not the same.
Yeah.
But the
business
bank
entity.
likes it because they're only on the hook for 50%
Right. Yeah, because
of
it's
the
covered.
original amount.
And so then there's not anything that needs to happen on the backside if something goes south. It's where the SBA is like giving the bank money. It's like, no, it's divvied from the beginning.
Yes.
Yeah.
Okay.
Correct.
Mhm.
Correct.
That's
So from our perspective, yes, it's an SBA 504 program,
Mhm.
but from the bank's perspective, it's really a conventional loan.
Right.
okay.
Their mortgage is
Oh,
conventional.
interesting.
Yeah.
Okay.
Yeah.
Wow.
And then the rate, a big difference too, is generally, not generally, but the rate is lower on the SBA side.
Yep.
Okay.
And it's fixed for the life of the loan.
It's a great product. I did many of them when I was in bank. I love the
Really?
504.
Yeah.
You wanted real estate? We're going 504.
Yeah.
Gotcha. And so, but
Yeah.
but there's limitations. You said it's typically used for real estate.
Strictly.
Yeah, it's
Buying commercial buildings.
Yeah, buildings or equipment. You can add on leasehold improvements. So,
But if you got a 7A
And you occupy
and you-
51%.
yes, that's a
Owner-occupied.
huge thing. It's got to be owner occupied. Yeah.
Okay. And so just go into that. I know that you were about to say something, but
Yeah,
just break
sorry.
down
Yeah, go
what
ahead.
that means, owner occupied, for those listening.
So in terms of square footage, I mean, you got to occupy 51%, and that can include common areas.
Mm-hmm.
That can also include outdoor space as well. So,
So
I
this
have
is
a,
relevant
Basements.
yes
to
yeah.
people that are
So-
leasing in like a strip mall or
Yes,
or that. Yeah.
Yes, it wouldn't apply.
Okay.
So I'll give you. So if you're in Brooklyn, right, and you've got multi-family, let's just say you've got 3 stories,
Mm-hmm.
okay, and there's no basement, right, or even if the basement is smaller than the perimeter of the structure,
Okay.
right, as long as if it doesn't, so let's just say if it's 50-50,
Mm-hmm.
right, then it does not qualify for SBA financing.
So if I owned a business,
business.
there's say there's 4 floors exactly the same.
Yep.
I own 2
Yep.
and another person owns 2, then I can't get.
Well, at that point, it's 50. Now you got the next question would be, well, what are the so there's hallways, right? So is there a hallway on level 3 or 4?
Okay.
If there's a utility closet,
That
either of
expands
those,
the space.
then that
Right.
you'll get
It gets to that level of
Yes.
detail.
Oh, it's based on
Yes.
square footage.
yes.
Holy. Okay.
Sure.
Okay. So it's
Yeah.
in the building, and this is a building that you would be buying if it's
Yes, correct.
no lease or anything
Or you own or acquired it via a SBA 7A loan.
okay.
Yeah.
And so you can use a 7A to purchase commercial real estate,
Yes,
but then
you can.
but then you're
And-
operating from a fixed interest rate perspective.
Well, the 7A is a
7A is
variable.
variable.
Variable,
Yeah,
not,
yeah.
not fixed.
So
I meant variable.
I'll give you.
But you can refinance the 7A with a 504.
with a 5, and that's what you were
Yes,
saying.
yeah.
Right.
So I'll give you an example on how we would probably look at it, right? So if we're looking at a business acquisition that came with the real estate, right? And the financials are kind of borderline. We would probably say, hey, look, right? We'll do this. Let's try and do this as an SBA 7A, right? With the idea of refinancing it as a 504 within about 2 years.
Okay.
You know, because in this way, major reason is our guarantee is 75% if we did it as a 50 as a 7A,
Okay.
as opposed to, so it's just, hey, look, it's borderline. Let's get you this product first. See how operations, see how you're able to manage the business and operations, and then down the line, after a couple of years of profitable years, we'll refinance you out with a 504.
So how would the 504, correct me if I'm wrong, that's where it's 50-40-10 as far as responsibility.
Correct.
Right.
And so when you make that transition from 75-25 or 75-15-10, is that what a 7A would be?
No, 7A, we can fund, I mean, it's a startup, so we'll need 10%. Yeah. So it would be 10% of equity contribution. So under the 7A, we can fund 90%.
Okay.
Yeah.
Okay.
Now, if it's an existing business, we can actually do 100%
Oh, okay.
of the financing under the 7A.
The SBA?
The SBA can.
Holy smokes.
Yeah.
That's kind of a big deal.
Yeah.
Get 100% that's backed by the SBA.
Yeah.
Well, the business is providing the equity.
Right. And so it all comes with the property then. It's like, would that be how that?
Yeah. So in
I
essence,
guess
it would
could
be the
work?
same as if you were an existing business and you were buying equipment, right? Or you were investing, or you were expanding your business. There's no equity requirement there.
Because we're just going to take it back. Like if it goes south, the bank will just take the equipment back.
Yeah,
Kind of a thing,
but
something like
we're
that.
not getting, yeah.
Not in the not necessarily in the repo business,
Yes,
but
exactly.
but
Yeah,
yeah,
exactly.
yeah.
Right. The last thing
But
that-
that's just as far as that's how like the collateral kind of works. It's built into the purchase because you're buying something that's tangible.
Yes, so in something like that, if we are buying equipment, right? If it's not new equipment, if it's used equipment, right? If it's coming with the business, then there has to be a valuation
That
done
makes
on
sense.
that. There's got to be a valuation done on the business as well.
That makes sense.
Right.
Yeah, no,
I did a 504 where it was a strip shopping center. It was 4 stores, but 2 of the stores was the owner of the shopping center, and with the square footage, even though that's on the surface 50%, but square footage wise, it was more than 50%. The 2 stores that he had.
And so that's where that comes into place when you own the entire structure and other people are you're inviting other businesses to come in.
Right.
You have to own and you have to occupy 51%
Yes,
of the
correct.
square footage of that.
Yep.
But do you include the rental revenue from the other 2? Most of the time you don't.
No.
You want to see
it's
cash
not
flow
an
without that.
SBA, right? SBA doesn't require, because if the SBA is looking at rental income, then it becomes an
Investment property.
Exactly.
Right.
So, but we do kind of make a note. It is represented in our write-ups that, you know what, hey,
There is additional
this is what
revenue.
it is, but there is additional income coming in.
Okay. I'm glad that you used the example a little bit ago with that $200,000 for the franchise because I wanted to ask just a few quick questions about franchising.